Your report points out Sydney remains the most unaffordable city to rent.
It is, and what that means is you need a higher income to be able to rent in Sydney to avoid rental stress. So the income for renting a house needs to be at $135,000 in Sydney, and for a unit it's actually not much less than that, it's only $5,000 lower. What we've got is the most affordable capital city is actually Melbourne and as well Hobart. So roughly about $100,000 is needed to avoid rental stress to rent a house. And all of the other capital cities kind of ladder in between that $100,000 and $135,000. So it's still a significant amount of income. And I think what this demonstrates is, particularly for lower income households, how challenged it has become.
We are starting 2026 with a significant structural shift in the Australian economy. As you just heard from the RBA, the wait and see period for mortgage holders has officially extended. We are currently tracking a supply-demand imbalance that is historically unprecedented. The national median rent has climbed to $681 per week, with Sydney hitting a staggering $817. What we are witnessing is not a temporary spike. It is an economic alert for every property owner and renter in the country. The RBA is navigating a narrow path, but that path has tightened as inflation remains at 3.3%, well above the target band. This means the price scenario update for February is no longer about if rates stay on hold, but rather when the next liquidity crisis triggers a corrective move. For those of you holding portfolios in Sydney or Melbourne, the data is clear. The income required to avoid rental stress has now surpassed $135,000 for a typical house. This is the heat that Prime Minister Albanese is facing as we enter this critical fourth year of his term. The government is attempting to pivot, but as the market intelligence suggests, the lag in building approvals means the supply-demand imbalance will likely define the entire 2026 fiscal year.
Cut in 2026. Have you figured one into your forecast?
So what we have figured into the forecast is obviously the impact of the 3 rate cuts that we've seen so far in 2025. That is still going to be flowing into the housing market, particularly in the first half of next year. I think our expectations are probably for one more rate cut midway through the year, but as we know that outlook can change very rapidly.
Domain's report says there'll be recoveries in the Melbourne and Canberra markets, so much so that you are expecting fresh record highs in all capital cities next year.
Melbourne and Canberra have been those 2 capital cities that really have lagged our other cities. They've just moved into an established recovery, and what our expectations are, they will be fully recovered by the end of 2026. And we're expecting all capital cities to see house and unit prices at fresh records. And we are also forecasting Sydney's median house price to hit just over $1.9 million by the end of next year. So that really does set the pathway for a $2 million median house price in Sydney by 2027.
The Prime Minister is doubling down on demand-side incentives. As of January 1st, the 5% deposit scheme has been completely uncapped. No income limits, no quotas. On paper, this is a win for first home buyers. However, as an analyst, we must look at the structural shift this creates. By injecting thousands of new buyers into a market with a 1.7% vacancy rate, we are effectively fueling market volatility. We are seeing a scenario where first home buyers are now in direct competition with seasoned investors for the same entry-level stock. This is creating a floor under prices that prevents any meaningful economic correction. If you are looking at the 2026 data, the Sydney median house price is already tracking toward the $1.9 million mark. This is the critical update for the week. The Help to Buy shared equity scheme is now live. The government is essentially becoming a co-owner in your home to keep the dream of ownership alive. But ask yourself, is this a solution to the housing crisis, or is it a mechanism to sustain high prices in an environment of policy pressure? We are seeing the heat intensify in the Senate, where the Greens and the Coalition are questioning the long-term sustainability of the Housing Australia Future Fund.
The real problem here is a lack of accountability and a swelling bureaucracy where key judgments about people's lives are made by people who have not been elected. And so in relation to housing, there are thousands of houses not being built in Australia because of environmental bureaucrats. And in relation to mortgages, there are, frankly, bureaucrats who decide who does and who doesn't get a mortgage in Australia. So I think the general point here is about accountability and ensuring...
Let's talk about the liquidity crisis from an investor's perspective. While the social media narrative focuses on the struggle of renters, the high RPM reality is that yield-hungry investors are seeing 2026 as a year of consolidation. With vacancy rates in Perth and Adelaide sitting below 1%, the power dynamic remains firmly a landlord's market. However, there is a risk of structural shift in the price scenario update. As the Prime Minister faces mounting pressure, we are seeing talk of targeted tax breaks or even bank lending constraints specifically for investors. This is the economic alert you need to be aware of. The government's number one priority is now affordability for younger generations, which often means headwinds for multi-property owners. If you are looking to deploy capital this year, focus on the infrastructure corridors highlighted in the latest 2026 budget. The outer urban fringes are receiving the bulk of the supply-demand focus. We are talking about regions like Melton in Victoria or Wilmot in NSW. These are the areas where the 5% deposit scheme is having its most profound impact. The bottom line for 2026, the Australian property market is not crashing. It is undergoing a structural shift where the government is becoming an active participant in the transaction. Between shared equity, uncapped deposit schemes, and a stubborn RBA, the 2026 market is more policy-driven than market-driven. Stay tuned for our next deep dive where we analyze the specific 2026 tax changes that could impact your negative gearing benefits. The heat on the Prime Minister is only going to rise as we approach the February RBA meeting.